Welcome back to the deep dive. You gave us the sources, the white papers, all that community chatter, the hard market data, and our mission, as always, is to cut through all that noise and give you a streamlined, actionable understanding. And today, we are diving deep into a really unexpected corner of the crypto world. We're looking at where the jokes, the memes actually start to meet real infrastructure. Okay, let's unpack this. Our focus is every.meme. The ticker is EVRY. And this is not just another meme coin. I mean, it's actively positioning itself as the foundational, well, the infrastructure for the meme economy, and it's all happening on Solana. So we have to tackle this core tension right up front. What actually happens when a sector that's, built on pure hype and speculation tries to get serious and introduce business logic?
Well, that tension is pretty much the central theme of all the source material you sent over. We're looking at a project that basically rejects the standard playbook for its peers.
Yeah.
So as of late December 2025, the data puts every squarely in the microcap sector. And, that's the high-risk, high-reward arena of crypto. We're talking about a market cap of around $2.26 million. The price is hovering just over a tenth of a cent, so about 0.0017.
And that context, especially that microcap status, is so important. You, the listener, you really need to understand that the sources all confirm that Every is, well, it's significantly lacking in that explosive daily volume.
Oh, completely.
The sheer, frequency of attention, the rapid 10x spikes in search trends, all the things that you see with those viral coins, it's just not there. It's the quiet house in a really loud neighborhood.
It is quiet, yeah, but I think it's deliberately quiet.
Yeah.
The entire claim that Every is making is staked on its utility mechanics. It's built around functional revenue-generating utility, and specifically these deflationary buyback mechanisms. And that stands in, stark contrast to its purely speculative counterpart. It's a very unusual contender because it's demanding a kind of fundamental business-like valuation in a marketplace where, let's be honest, the main currency is just cultural speculation.
It really does sound like a highly disciplined company trying to compete in a circus. So I have to ask, based on the material, is safer even a word we can use in this corner of the Solana ecosystem? I mean, what metrics suggest this is anything other than just relative safety in a place that's inherently high risk?
That is the critical question, and it's the one the project is really trying to answer with its marketing. They absolutely acknowledge the risk. You can't ignore it. But they're aiming to mitigate it by aligning the investor's interests with the platform's growth, not with just, external luck or a celebrity tweet. The sources show their positioning is unique because they're not selling you the idea of finding gold. They're selling you the shovels. They're selling the carts, the picks, the whole mining camp infrastructure.
That brings us right to the narrative they're building. If they're going to stand out among, all the cartoon dogs and cats, they need a really compelling, almost mature analogy. And the first thing that just jumps out from all the research is that branding choice. They're not trying to be cute. They're not using nostalgia. They are pitching a very straightforward, very recognizable business analogy. They are branding themselves as the Shopify of meme coins.
And that's a highly calculated move. It's designed to immediately, differentiate them from that saturation of animal tokens we were just talking about. The core hook isn't just simplicity, it's about empowering creators. They're making the argument that launching a new, fully customized token should be simple. It should be accessible to everyone, independent content creators, brands trying to engage their community, anyone building a niche group, and all of it without needing deep technical expertise in deploying a smart contract.
That hook is so important because even just a few years ago, deploying a token with a custom contract with all the right security measures, especially on a chain like Solana, that was a huge technical hurdle.
Oh, yeah.
It meant you needed a developer, you needed careful auditing, you often had high fees. If Every is really providing a standardized, tested, kind of click and launch structure, they're basically taking a complex service and productizing it.
They're commoditizing the means of production for their own competition. And in the Solana ecosystem, where the speed of a token launch can often make or break its initial success, that kind of efficiency is a really powerful value proposition. The platform offers this clean, audited template that lets creators focus on what they're good at, community building, marketing, instead of worrying about the underlying contract code.
Okay, but if they successfully commoditize the launch process, doesn't that just dramatically increase the amount of competition? Why would an investor want to bet on a token that exists just to help create more competition?
Because you're fundamentally changing what you're investing in. You're shifting your focus. In a market that is just absolutely drowning in speculative assets, Every is positioning itself as the infrastructure play. They are specifically appealing to the investor who's been burned a few times. They're the one who's tired of the pump and dump cycles of most memes. What's fascinating here is how the project uses this to sort of redefine what risk even means in this space. They're targeting those definitive users, the ones looking for that safer bet. Now, safety isn't guaranteed, of course, but the value proposition is tied to something demonstrable, something measurable, the platform fees, not just relying on continued, unpredictable viral hype.
So the narrative becomes, instead of gambling on which new token is going to be the next big thing, you invest in the platform that takes a tiny slice of revenue from all the new tokens, no matter which one wins.
Exactly. You buy the shovel seller, which is a much more structural bet. Your success is tied to the overall activity level of the entire market, the sheer volume of new launches, rather than the singular, binary success of finding that next 1000x gem. It completely shifts the investment thesis from a speculative cultural bet to a quantifiable bet on the adoption and the sustained use of the underlying tech.
That's a really sophisticated pivot for a project that's, technically operating in the meme space. But we've talked about the corporate paint job. Now we have to ask, does the engine under the hood actually match that narrative? Let's get into the math, the mechanisms. This is the deepest part of our dive.
Right. And this emphasis on a verifiable structure, it's all underpinned by the project's hybrid economics. If the Shopify story is the brand, then the really aggressive fee redistribution model, that's the actual engine that's driving the valuation.
So the strongest pillar here has to be the functional DApp Launchpad itself. And it's so important to stress this isn't just a promise in a white paper, it's a working tool. It lets anyone deploy a token on Solana, setting their own custom parameters. The sources are clear. It is generating real fee revenue right now.
And we should probably elaborate on the complexity that the Launchpad just abstracts away for the user. When we say custom parameters, we're talking about creators getting control over really crucial elements.
Like what, specifically?
Well, like the total token supply, for one. The distribution method, is it a fair launch, a liquidity bootstrap, a fixed sale? And even critical contract functions like freezing the mint authority or revoking update authorities, which are key to proving to your future token buyers that the project is secure. This is real technical sophistication, just delivered in a simple package.
And every single time one of those tokens is launched, fees get collected. Let's break down where that revenue goes, because this is the critical part for any listener trying to track the fundamental value here. It's this 4-bucket system they market so heavily as their deflationary mechanics.
Okay, so the first and definitely the most talked about bucket is the buyback protocol. A massive 30% of all the platform fees they collect, both from the initial launches and any future trading fees that they might implement. All of it gets funneled immediately into market support.
Wait, 30%, that's an enormous percentage. How does that mechanism actually work on a technical level?
So the protocol is designed to be autonomous, or at least quasi-autonomous. As the fees build up, the protocol triggers a market buy order for every tokens right off the open exchanges, mostly the decentralized ones on Solana. This creates this constant platform-driven buying pressure. But here's the key distinction. Those tokens that are bought back, they are immediately and permanently burned. They're just removed from the circulating supply forever.
The significance of a sustained 30% buy and burn. I mean, in a low liquidity microcap environment, that effect is magnified so dramatically. A constant, reliable, platform-driven demand acts as a kind of structural price floor. It means every single dollar the platform earns translates into 30 cents of guaranteed market support and permanent deflation.
And that creates the direct incentive loop that the whole project relies on. Their de facto marketing slogan becomes something like, the more other people use our platform to launch their tokens, the smaller the supply of every gets, and the greater the upward price pressure.
Yeah.
It links the utility, the successful launches of other people's tokens directly and mathematically to the price action of every itself. It's their way of saying, look, you don't need a celebrity shilling this or the core team constantly hyping it. The economics do the marketing for us.
But I see a potential downside there. An aggressive burn like that, it really emphasizes short-term token velocity over long-term strategic growth. Is it really sustainable to just allocate almost a third of your revenue to buying back your own token?
And that's where the other allocations come in to provide that necessary balance. This project is really designed for the long game, and that's reflected in the next largest allocation. 40% goes straight to treasury growth.
Okay.
And this funding is crucial for avoiding the kind of stagnation that kills so many utility tokens. That 40% ensures the whole Shopify vision can actually keep evolving. This treasury is what they use to fund ongoing development, new features for the Launchpad, maybe integration with other Solana protocols, all the necessary security audits, and sustained marketing campaigns to promote the platform itself, not just the token. I mean, in a fast-moving ecosystem like Solana, if you're not constantly building and iterating on the platform, the utility gets outdated really fast, and then the fee generation just dries up.
Right, it's the R&D budget. You absolutely need that 40% just to stay relevant. If the platform stops getting better, people will just find a cheaper or a faster or more feature-rich way to launch their token.
Absolutely. Then you move to the stability components. 20% of all that fee revenue is specifically, non-negotiably allocated to liquidity provision. And in the microcap world, liquidity provision is like, it's the unsung hero of investor safety.
Okay, for the listener, can you break that down? Why is 20% dedicated to liquidity provisions so vital in this really volatile Solana microcap sector?
It's all about slippage and volatility. When you have a token with a market cap of only a couple $1,000,000, there just isn't a deep pool of capital there to absorb large buy or sell orders. So if a whale tries to sell even a relatively small amount of tokens, the price impact, the slippage, can be massive. It can cause a cascade of panic selling. By dedicating 20% of the revenue to deepening that liquidity pool, the protocol is actively working to make sure trades execute smoothly and that the token is more resilient to big price swings. It reinforces that whole narrative of being a safer bet by providing real trading stability.
So that 20% is directly addressing the technical risk of market fragmentation and panic, while the 30% burn is addressing the demand side. And then that last 10%, that seems to close the loop on the network effects.
That's the 10% allocated to creator incentives. And this is the budget that literally pays people to build on their infrastructure. So if a token launched on every day is really successful, maybe it hits a certain market cap or it achieves specific trading volume targets, the creator gets rewarded with a piece of this incentive pool.
So they're literally paying people to succeed on their platform, which in turn reinforces the whole ecosystem. The creator gets paid, they get validated, everyone gets the fee revenue, the liquidity, the treasury growth, and that deflationary pressure.
It transforms the platform from just a simple tool into a genuine ecosystem designed for mutual success. It's a very robust, hybrid model. It's blending those immediate deflationary mechanics, the 30% burn, with sustainable future development from the 40% treasury, and that critical market stability from the 20% in LP.
And looking ahead, the utility doesn't just stop with distributing fees. The governance piece is a major, though maybe underdeveloped, pillar for the long-term holders.
That's right. While the current operation is pretty centralized, for efficiency's sake, the source material is very clear about the plans for future governance. Holders of Evri are slated to get voting rights on critical protocol parameters. And this moves you beyond just simple token holding into something closer to genuine ownership.
What kind of parameters would a long-term holder actually get to vote on?
Things that directly impact the economics we just went through. They could vote on, say, adjusting the fee rates for new launches, or they could vote on proposals for how the treasury funds get spent, which new features to prioritize, which security audits to commission, which marketing campaigns to fund. It adds this crucial layer of control and utility, making sure the long-term holders are essentially stakeholders in the platform's strategic direction.
That sounds great in theory, but what kind of risk does that introduce? I mean, if the holders gain control, what's to stop a malicious actor from just buying up enough tokens to vote for a, say, 100% fee burn and just destroying the growth budget for a short-term pump?
That's a risk that's inherent in, all decentralized governance models. The sources don't really detail the exact anti-whale or time lock mechanisms they plan to implement, but any sound governance structure has to include safeguards. Things like, minimum voting periods or requiring a supermajority for any changes to critical parameters, anything to prevent rapid destructive changes. The implementation of that governance system will be a really key signal to watch, specifically how they balance that efficiency with decentralization and security. It's about making sure the focus stays on building, not just extracting value.
All right, let's move from the mechanics of the project to the people, because this is where Evri's unique positioning really starts to show itself, and it addresses one of your big concerns, listener, about information overload. We are contrasting very low-volume noise with very high-quality engagement.
Yeah, if you've ever spent any time in a typical microcap meme community, it's often just chaos. It's rapid, it's emotional, and it's characterized by a lot of noise. The Evri community profile based on all the source material is strikingly different. The user base is Well, it's overwhelmingly composed of DeFi native individuals. They're investors, not just gamblers. These are the kinds of people who actually read the source code, or at the very least, they read the detailed tokenomics. They track smart contract activity. They look for measurable indicators of health. And this results in a community atmosphere that is professional, patient, and just remarkably quiet compared to the frenetic energy of a viral meme Discord channel.
I can almost hear the silence. So if they're not all just spamming when moon, what are the specific topics that are actually dominating their conversations?
The content focus is highly technical. It's metric-driven. They're talking about treasury growth, tracking the actual dollar value that's accumulated in that 40% bucket. They're talking about liquidity provision measuring the depth and resilience of the trading pools. They are discussing protocol revenue and adoption metrics, not celebrity speculation. It just indicates a community of sophisticated holders who actually understand the underlying business logic, and that's very different from a reactive, fleeting raider community.
That patience. It suggests they're all waiting for a specific event to come along and validate their investment, doesn't it?
Exactly. They know that the shovel seller thesis is only proven when a big gold rush actually happens. The community is basically waiting for a breakout hit token and launch on the Every.meme platform. The ultimate proof of concept isn't an official announcement from the Every team. It's a token that was launched using the platform that achieves viral scale. Something that hits a $50 million or $100 million market cap. That would demonstrate the platform's technical strength and its ability to scale up quickly.
Let's ground this in some hard metrics. Let's look at their social media presence, specifically on Twitter X, because this is where that quiet confidence is most measurable.
The volume is. It's startlingly low compared to the ecosystem norm. Our research estimates only about 20 to 50 posts per day that even mention the ticker, Every Ep. You see these small, predictable little clusters of posts when the official account announces the development update, or, most reliably, right after a scheduled buyback and burn event gets verified on the blockchain. But otherwise, it just falls into these quiet, steady periods.
And we have to contextualize that volume for the listener. What does 20 to 50 posts a day really mean when you compare it to a direct competitor of the exact same size?
It means they are virtually invisible to the casual observer. I mean, take a hypothetical hot trending coin in the exact same $2.3 million market cap range. Let's just call it PFFY for a second. PFFY, which is leveraging hype and FOMO, would probably see 500 to 1,000, maybe even 1,500 posts per day. The difference is orders of magnitude, and it tells you everything you need to know about the investment expectation. Every volume is consistent only with a niche, low-cap utility project, not a speculative meme play.
So the project has actively traded that potential for rapid hype for the promise of, well, demonstrable substance. But what's the danger of being this quiet? Does that low social volume hurt their resilience when the market turns down?
It's a real double-edged sword. On one hand, yeah, low volume means less manufactured excitement, but it also means that if platform usage stalls, or if they face some kind of technical challenge, the community response might be slower and less visible. However, the quality of the engagement seems to compensate. The few posts that do show up are typically from long-term holders doing these analytical dives chart analysis, commentary on how effective the deflationary mechanics are, or discussions about the valuation relative to revenue.
So the engagement drivers are purely product delivery, and the economic incentives, the buybacks themselves, not that viral cult energy that so often relies on just novelty and FOMO.
That is the key takeaway here. Every purse has the lowest raw noise and spam volume in its entire peer group. But precisely because the volume is low and the community is so technically proficient, they potentially have the highest quality engagement per post. You just have fewer bots, less noise, and way more genuine investors actually discussing the mechanics. They definitely lose the battle on immediate visibility and hype, but they seem to be building for sustainability and resilience based on fundamentals.
Okay, here's where it gets really interesting. To truly gauge the wisdom of this choice, the structural choice, we need to compare every, not just conceptually, but directly against its neighbors. Our sources gave us a snapshot comparing Every to 3 other Solana projects with almost identical market caps, all clustered between about $2.3 and $2.6 million as of December 2025. This comparison shows 4 radically different strategies, all fighting for the exact same microcap investment dollar.
Let's walk through this peer comparison table, and let's focus on the strategy and the inherent risk profile of each one. The market caps are all basically the same, but the approach to attracting capital just couldn't be more different. So first, you've got Every itself at $2.26 million. We've established its style, analytical, product-focused. The whole sentiment is driven by this idea of undervalued tech. Investors are tracking buybacks, they're tracking dev updates. The risk here is slow adoption or just failing to land that breakout hit launch. It's a structural risk.
Okay, next up, let's look at TS Yukai sitting right around $2.35 million. The engagement style here is labeled cult mystery. This is a completely different universe.
TSC Kai is pure engagement warfare. It generates that high raw volume. We talked about 150 to 300 plus posts a day, and its entire vibe is the movement. This project is fueled by requiring constant active participation from its community. This could be daily puzzle solving, engaging with a really deep, evolving anime lore, or participating in these social campaigns the community calls work for your bags.
So TSE isn't selling a business at all. It's selling an immersive, high-touch experience. What's the specific investor risk that comes with that kind of model?
The risk is high-touch fatigue and a total dependence on narrative. If you invest in TSE, you are betting on the sustained willingness of a community to participate in really intense social efforts. Success depends entirely on the continued appeal of the story and the consistent delivery of new puzzles or lore. If the core devs or the community leaders who are driving that narrative just disappear, or if the participation rate drops because people get tired, the movement stalls and the valuation collapses, why? Because there's no underlying revenue-generating utility to fall back on. It's a high burnout model.
That is a sharp contrast with Every, which is just asking you to track a dashboard, not solve a daily puzzle.
Okay,
Now let's pivot to Mother at $2.39 million. This project is defined by two words: celebrity chaos.
oh, Mother is an absolute textbook example of non-fungible risk. Its volatility is entirely tied to external factors, specifically its association with the musician Iggy Azalea. The posting volume swings violently, from 100 posts a day to over 500 whenever she engages. The vibe is inherently polarizing because that celebrity association drives both fervent, passionate support and a lot of cynical opposition.
For an investor, what is the inherent danger of tying your value to a single, highly visible personality?
The risk is total dependence and unpredictability. You are betting on that celebrity's continued interest, you're betting on their public image staying positive, and you're betting on their legal status remaining stable. None of those things are within the control of a token holder or even the core team. If the celebrity loses interest or if they have a scandal, the token's value can collapse immediately and completely. The source material really highlights this as the ultimate chaotic risk. High potential for rapid pumps, sure, but zero long-term predictability or foundational support. Everyone needs 100 small creators to launch successfully. Mother just needs one celebrity to stay perpetually engaged.
And finally, we have Maddie I, slightly larger at $2.63 million.
Right. And the Naked Ania represents the classic meme template. It has steady, moderate volume, let's say 50 to 100 posts a day, and its goal is to achieve that standard community takeover vibe. It relies on good distribution, viral momentum, a strong community, a sense of humor, and while the engagement is decent, the sources explicitly note its major weakness. It lacks that unique built-in utility hook that Every possesses. It's a standard speculative bet, just one that's performed well enough to maintain its relevance in this microcap cluster. You're betting on a meme, pure and simple.
This table really paints a comprehensive picture. You have 4 projects, all the same size, but they're offering 4 wildly different strategies. Every is selling a business model, Tiaki is selling a cultural experience, Mother is selling a personality bet, and Matai is selling a traditional speculative gamble.
The synthesis is just crystal clear. Every way is a structural anomaly. It is choosing to optimize for stability and measurable progress over hype and volatility. If you, the listener, are looking for that instant high-octane attention of a project like Trusuki or the chaotic ride driven by celebrity influence like Mother, the social metrics of Every will be a huge disappointment. You will feel bored. But if you are seeking a metric-driven, fundamental bet one where success is mathematically tied to quantifiable platform usage and guaranteed deflationary mechanics, then Every offers a genuinely distinct and frankly mature alternative within a notoriously speculative sector. It's a bet on operational efficiency and adoption, not on the cultural zeitgeist.
So what does this all mean? Let's bring us all home with a final synthesis that directly addresses your research mission. The verdict is that if your goal was to find a microcap play that's tied to product development instead of pure hype, well, the sources suggest Every fulfills that criteria, but it requires a totally different way of monitoring. Everything's not the play for viral raids or for instant pump speculation. You should temper any of those short-term expectations immediately. But because it's a different kind of animal, the way you track its success has to be fundamentally different too.
You just can't use the standard meme metrics. You can't use likes, followers, or the volume of tweets to gauge its health. Those metrics are measuring noise. Every success is tied to utility. The single most important metric for you to track going forward is the number of daily launches on the Every.meme platform. That metric right there, that is the core leading indicator for price action, not what the community is posting about on Twitter.
And that traces directly back to that 30% buyback protocol we talked about. Every launch drives fees, and 30% of those fees immediately go to buy and burn every way. The causal link is direct. Platform activity leads to deflationary pressure.
Exactly. The relevance check here is vital. The success of Every is intrinsically and structurally tied to the success of other creators using their platform. This is what defines their partnership marketing strategy. They only succeed when their customers succeed.
Which brings us to their unique growth model. Instead of, paying a celebrity $1 million for a few tweets, which would be the mother model, they're using that 40% treasury allocation and the 10% creator incentives to actually onboard external creators to launch their own tokens on the platform.
This is systemically ingenious. By focusing all their marketing efforts on onboarding external creators, popular YouTubers, niche artists, community leaders, to launch their tokens on the Every.meme launchpad, the platform is effectively leveraging those external pre-existing audiences as decentralized marketing for Every itself. So the creator promotes their new coin to their audience. That drives adoption and transaction volume for the new coin. And in doing so, they're driving usage and fee collection for EveryUs. It is a unique, systemic, and essential component of this model that just differentiates it from every single peer that we examined. You're betting that they can successfully sell enough shovels to enough gold miners that the cumulative fee revenue generates real value.
It's a decentralized, symbiotic marketing flywheel, a sophisticated operational thesis in a sector that rarely warrants that term.
Precisely. It turns the entire ecosystem into its own persistent marketing arm, which is far more resilient than just relying on a single moment of virality.
This has been a deep and, I think, a really necessary look at a token that demands a different lens of analysis. If utility is what you're actually seeking in the microcap meme space, this model presents a unique fundamental bet based on revenue generation rather than pure speculation.
And if we connect this to the bigger picture, the listener should probably step back and consider this question. Does the emergence and, the structural viability of platforms like Every, which focus on fee generation and structured deflation, does that signal a broader maturity point in the meme coin space? Are investors, even at this incredibly volatile microcap level, starting to favor underlying business logic and demonstrable economic loops over pure speculative hype and cultural momentum?
That is a fundamental question for the future of decentralized asset creation. Thank you for walking us through the dense mechanics, the really unique community dynamics, and the place that Every.meme holds in the Solana market. So your key action item now, listener, is to stop checking those fleeting social media trend charts. Instead, dive into the platform's public data if you can find it. Track the verifiable number of daily launches and the resulting buyback figures. That is the true pulse of this infrastructure project.
And remember the final provocative thought. Every's model requires others to succeed for it to succeed. This interdependence makes it reliant on the entire ecosystem's health. Is this type of systemic dependency a more sustainable form of crypto revenue generation than relying entirely on pure, volatile transaction volume alone? Something to chew on as you continue your research into the future of decentralized value creation.
We'll catch you on the next deep dive.